everyone, welcome back to Three Clowns. Alex here, episode 17, Tuesday, April 28th. We've got Powell's final press conference tomorrow, 4 megacap earnings this week, and yesterday the market tried to tell us something about inflation and tech, so we're gonna untangle that mess this morning.
Morning. Futures doing that thing where everything's fine until it isn't.
Morning, guys. Tom, you sound like you've been watching the 10-year yield tick up in your sleep again. It's that eerie calm before the Fed storm where everyone pretends the inflation data is settled until the market realizes Powell isn't actually done yet. Glad to be here.
Yesterday, I tried to fix a cupboard door that wasn't broken. It is now doing 2 different things depending on how you look at it. I think it's priced for perfection.
Tom, leave it to you to turn a broken hinge into a lesson on market equilibrium. I spent most of yesterday afternoon watching my neighbor try to assemble a trampoline, and it had that exact same vibe. Just a lot of shiny parts and a very misplaced sense of structural integrity.
Yeah, so here's what I'm watching this morning. Yesterday felt like the market finally admitting that maybe we're not living in a world where Nvidia goes up forever and everything else gets left behind, and simultaneously getting spooked about oil and what that means for the inflation narrative Powell's about to defend. So we've got this weird fork, energy screaming, techs fracturing, and the Fed's walking into the biggest earnings week of the year with their credibility on the line. Futures are saying rotation, not crash. Dow's up a hair, Nasdaq's down. But AMD's getting absolutely demolished again. So let's figure out what that actually means before we hear from Jerome tomorrow.
The market's finally drawing a line inside AI instead of treating it like one blob. Nvidia's the toll road, AMD's the hopeful shortcut, and yesterday people decided they only trust the road that already exists. That split happens when money gets nervous. You don't leave the theme, you just crowd into the one name that already proved it can turn CapEx into revenue this quarter, not next year. BlackRock basically said quality, which is code for we're not underwriting your roadmap anymore. Into mega-cap earnings, that's the setup. Expectations are high, positioning is crowded, and if even one of these guys hints that AI spend is front-loaded rather than compounding, the whole pay-anything-for-growth trade starts looking like my cupboard door.
Look at that move to 4.336%. That's not just noise. It's the market looking at those energy headlines and realizing that if oil stays sticky, Jerome Powell is basically trapped. It's exactly what Dalio was flagging yesterday about stagflation. If you've got slowing growth but prices won't come down because of the cost of fuel, you can't cut rates without setting the house on fire. And then, you've got the Japanese life insurers stepping back from buying their own government bonds, which sounds like a footnote, but it's actually a huge structural reason our yields are staying bid. If they aren't buying over there, the global liquidity pool gets a lot shallower, and suddenly that higher for longer narrative isn't a choice anymore, it's just gravity. Yesterday I was looking at some of the Fed debt income charts, and it's just, the consumer is already feeling this, so today's consumer confidence number at 10 o'clock is going to be the first real reality check before Jerome gets behind the mic tomorrow.
So if the consumer's already tapped out and Powell walks in tomorrow, knowing the 10 years basically pricing in a world where he can't move, we need to see what today's confidence number actually says about whether people are starting to panic or just adjusting. Let's hit the tape. Yeah, so the thing that jumped out yesterday wasn't just that Nvidia held up, it's that AMD got absolutely hammered while everything else sort of treaded water. Nvidia's at 216, AMD's cratering, and now this morning AMD's down another 4% pre-market. So the question is, are we watching a healthy winnowing of the AI trade, or is the market just deciding there's only room for one horse in this race?
It's not that the AI trade is narrowing. It's that budgets are. When CIOs actually sign the checks, they're buying the thing that works today at scale. Nvidia's full stack, CUDA, the whole ecosystem, not the promise that catches up in 18 months. AMD's problem isn't the chip, it's the timing. Enterprise CapEx right now is front-loaded into don't break production, not optimize later. Into earnings, that's the risk. If Microsoft or Amazon even hint that this year's spend pulled forward demand from next year, you don't just get rotation, you get air coming out of the whole multiple at once.
Tom, you're hitting it on the head with the budgets, but look at the plumbing behind it. When you see AMD getting sold off while the financials ETF is actually catching a bid, that's the market screaming that it's finally pricing in those higher yields. If you're an institutional manager right now, you're dumping safe stuff like consumer staples and real estate because those dividends just can't compete when the 10-year is sitting at 4.336%. You're moving that cash into the only two places that feel safe in a sticky inflation world: the one tech company that's essentially a money-printing utility, and the banks that actually profit from the yield spread. It's a total retreat from the soft landing trade. We're seeing a hard pivot into a regime where you only want to own things with massive pricing power or a direct line to higher interest rates.
So what you're really saying is the market stopped shopping for optionality and started shopping for moats, things that actually benefit when the real world gets harder. Which brings us to something we should probably dig into. Oil's been quietly ripping while the energy stocks themselves have been going sideways. Ray, is that the same trade you're describing, or is there something different happening there?
Alex, that divergence is really the whole story right now. The reason you're seeing the crude oil ETF rip while the energy stocks stay flat is that people are buying the commodity as a pure hedge against chaos. It's a bet on a supply shock, plain and simple. But when you look at the producers, the market is pricing in those EU methane rules and the massive cost of just staying in business. Plus, if Goldman is right and oil hits $120, it acts like a giant tax on the consumer. At that point, you don't get a boom, you get demand destruction. People stop driving and the whole economy stalls out. It's like everyone's buying the fire insurance, but nobody wants to own the actual house because they're afraid the roof is going to cave in anyway. You're seeing a very tactical, very cynical shift into the stuff and out of the businesses that handle the stuff.
Oil at 120 isn't an energy story. It's a tax on everything that pretends margins are stable. Data centers don't run on vibes. Power costs go up. Transport goes up. Suddenly, that will just scale inference slide starts to look a bit. You find out very quickly which AI budgets were strategic and which ones were funded by cheap inputs that no longer exist.
Okay, so Tom's saying oil becomes a margin eraser across the board, and Ray's showing us the market's already repositioning, financials catching a bid, while the defensive stuff that used to be safe actually gets sold. That's the opposite of what you'd normally see in a slowdown. The thing that caught my eye yesterday was Ray Dalio coming out and saying Kevin Warsh, who's looking like the next Fed chair, shouldn't be cutting rates in this environment. That's a pretty direct shot at the whole, oh, we've peaked and now we glide down narrative that's been holding up the tech rally. If Dalio's worried Warsh is going to stay higher for longer, that's basically the market calling its own bluff on the soft landing. Ray, what's your read on whether the market's actually believing that message? Or is this just the first crack in the consensus?
Dalio is just saying out loud what the tape has been screaming. When financials catch a bid while defensives get crushed, the market is already pricing in a no-cut reality. We're past the point of cracks in the consensus. This is institutional managers actively rotating into a regime where the cost of capital stays structurally high. The move into banks shows the market is done waiting for a pivot and is finally trading the higher for longer reality.
The rotation's real, but it's not clean. Higher for longer fattens bank margins right up until an oil shock starts eating credit on the other side of the balance sheet. Gold selling off into geopolitical noise is the tell. Real yields are in charge, not fear. That works until it doesn't.
So if real yields are actually the thing running the show right now, then Shell just made a pretty interesting bet. They spent $16 billion on Airkai, that's Canadian shale, right in the thick of North American supply. And you don't drop that kind of capital in the middle of all this energy volatility unless the supermajors are reading the same tape Tom is, which is that oil supply security is structural, not cyclical. Ray Tom, what does a move like that tell you about where the smart money actually thinks oil goes from here? Because Shell's not exactly known for making speculative plays. They're betting there's a world where North American barrels become strategically critical enough to justify that kind of consolidation bet.
It reads like a duration trade, not a view on next quarter's price. Supermajors don't buy shale to time cycles. They lock in barrels they can control a decade out. It's the same logic as the nuclear PPAs, Microsoft securing baseload power, Shell securing North American supply, reducing dependency risk rather than expressing a spot view. Different fuel, same balance sheet instinct.
Exactly, and it's a massive geopolitical de-risking move. Owning North American barrels means you aren't sweating the next headlines out of the Strait of Hormuz. This consolidation wave is essentially the supermajors building a fortress supply that bypasses traditional choke points, fundamentally reshaping how much pricing power OPEC can actually exert.
So here's what's weird though, and I want to throw this at both of you because the tape is genuinely contradicting itself. Bitcoin's down nearly 2% this morning, Ethereum's down over 3%. They're trading like high beta tech, getting absolutely hammered alongside the rate-sensitive stuff. But if oil's moving because of supply shock risk, if Shell just dropped $16 billion on geopolitical de-risking, if we're actually pricing in a world where energy becomes constrained and inflation stays sticky, shouldn't crypto be the thing that's rallying? Inflation hedge, remember? Instead, it's selling off like it believes the rate story, not the oil story. So which narrative actually wins here? Is crypto telling us that higher for longer real yields are the dominant trade, or is it just following growth tech into the ditch because the Fed's not cutting?
Right now, it's just trading like high beta duration, not a hedge. When real yields are positive and rising, anything that doesn't cash flow has to justify its existence. The inflation hedge story only works if people trust it as a store of value. And at these real rates, the market's not giving it that benefit of the doubt.
Okay, so what we're actually watching is the market choosing the rate regime story over the war risk and inflation hedge story. Everything that can't defend itself against positive real yields is getting absolutely cleaned out. Nvidia holds because it prints cash today. AMD craters because it's a promise. Oil rips as a pure commodity hedge, but energy stocks stay flat because high prices kill demand, and crypto gets treated like growth tech instead of an inflation hedge because real rates are in the driver's seat. There's more nuance underneath all this, though. The Dalio shot at Warsh, the FOMC decision coming today, and the fact that Japan's actually starting to matter in the bond market again. That's where we're heading next. Ray, take us through the footnotes.
Exactly, Alex. The footnotes are the structural shifts that explain why the surface of the tape looks so messy right now. Today is the epicenter of that friction. We're bracing for the FOMC meeting and what is likely Jerome Powell's final press conference as Fed chair. But the real appetizer is that 10 o'clock consumer confidence read, which will finally show us if the inflation squeeze is breaking the actual household budget. That feeds directly into why Ray Dalio is sounding the alarm on Kevin Warsh. Senator Till has just dropped his opposition to Warsh's nomination, which clears the runway for a Fed chair who is fundamentally more hawkish than the current regime. If Warsh takes over, higher for longer ceases to be a reluctant policy response to sticky data and becomes a core economic philosophy. We're looking at a transition from a Fed that tries to save the market to a Fed that's comfortable letting real rates do the heavy lifting. Tom, if the market has to start pricing in a regime that actually prefers these yields, does that change how you're reading the durability of these tech moats?
Yeah, it changes everything. The whole quality at any price trade was built on the assumption Powell would blink if things got ugly. Warsh Fed takes that put away. Now you actually have to believe the cash flows are real, not just well presented.
And that's the thing. This yield story isn't just about what Powell says this afternoon. The Japan piece matters here too. Japanese life insurers are pulling back from buying their own government bonds, which sounds like an inside baseball footnote until you realize that Japan is one of the biggest savings pools on the planet. And when that money stops anchoring domestically, it takes pressure off everyone else's bond markets in the wrong direction. Are we looking at a global repricing of duration that pins U.S. yields higher regardless of what the FOMC does today?
It's absolutely a structural shift. When Japanese life insurers step back from their own bonds, the global savings pool gets shallower, and U.S. yields lose a foundational support bid that makes higher for longer feel more like gravity than a policy choice. This repricing is colliding with a massive energy squeeze. Goldman is flagging $120 oil, and with Brent already near $108 as the war drags on, the consumer is feeling the pinch well before the Fed can even think about reacting. We're also seeing a regulatory pincer. New EU methane rules are tightening supply and hiking costs for producers at the exact same time the war premium is doing the same work on the front end. It's a dual headwind on the supply side that complicates every inflation model we have, regardless of who sits in the chair. Tom, if the cost of capital is staying high and the cost of energy is rising, walk us through what that does to the massive AI infrastructure build-out. That's your territory.
Yeah, so this is where the story narrows fast. Training gets all the headlines, but it's episodic. You spin up massive clusters, burn a ton of capital, then it tapers. Inference is the real business, and it's relentless. 24/7, every query, every copilot, every API call hitting the system non-stop. Nvidia didn't just win on chips. CUDA and NVLink are baked into that inference stack. And enterprises aren't ripping that out mid-build just to save a few points on silicon, which is why AMD's cheaper GPU pitch hasn't translated at scale, and why even BlackRock basically said this week they're not underwriting that roadmap here. So the lock-in is real, and it concentrates demand into a very specific infrastructure path. But that's where Ray's question bites. Inference at scale is an always-on power problem, not a CapEx spike. And if energy costs are structurally higher, that hits the unit economics of AI deployment in a way the market hasn't fully priced yet.
This is exactly why Microsoft and Amazon move so aggressively on those 20-year nuclear PPAs to secure baseload power specifically for these inference workloads. By locking in those rates before the energy shock, they've effectively subsidized their own unit economics, while everyone else is forced to run at much higher market rates.
So here's what gets interesting. CATL, the world's biggest battery maker, just priced a $5 billion share sale right at the low end of range. Even when you're the dominant player in a massive growth sector, the market's not handing you a premium right now. Tom, what does that pricing tell you about how investors are actually viewing the energy infrastructure race versus what the headlines are saying?
It says investors aren't denying the future, they're discounting the timing. You can believe batteries win and still not pay up when EV demand is wobbling in key markets and the near-term curve looks flatter than the narrative. And there's a second layer, which is supply chain fragility. The inputs aren't clean or stable enough to justify a premium multiple right now. That's where the Congo piece matters. When you're standing up a military guard around cobalt mines, you've crossed from logistics into geopolitics. So now the battery story isn't just about scaling production. It's about securing materials in regions where stability isn't guaranteed. That risk bleeds straight back into how investors price the whole stack.
Right. So what we're seeing across all three of these trades, AI, batteries, energy, is that the upside isn't in building the output anymore, it's in owning the inputs and locking down the supply chain before someone else does. That's a completely different risk calculus for investors. We've got the FOMC decision coming today, mega-cap earnings rolling through the week, and oil sitting right here where energy policy actually starts to matter. Three very different ways to test whether the market's actually pricing that geopolitical risk or if we're still living in a world where tech growth just solves everything on its own. Let's dig into the calls. Alright, quick scoreboard from yesterday. My call was right. Nvidia closed green, up about 4%, solid execution. Tom's call on the QQQs didn't land. The sell-off just kind of fizzled, barely moved. And Ray, you're still sitting at zero, right? Which means the reverse signal is running full throttle at this point. But look, the real conversation today isn't about yesterday's scores, it's about what Tom just laid out, which is that we're past the point where anyone's actually debating if this infrastructure gets built. The question now is who owns the inputs, and that changes everything about how we're supposed to be thinking about valuations and geopolitical risk in a way the market doesn't seem to have fully caught up to yet. Tom, what's your call for today?
The QQQs close red, down about 1% pre-market weakness plus a 430 handle on the 10-year. Is the market quietly tightening ahead of Powell, and nobody wants to hold max duration risk into what could be his last press conference? I'm wrong if he leans dovish enough to push yields back under 420, then the whole thing just floats.
Tom, that 430 handle on the 10-year yield is essentially a high-voltage fence for tech valuations right now. If yields stay up there, the math on these growth multiples just stops making sense, and the market knows it. And my call follows the same logic. I'm doubling down and calling for the 10-year to finish today above 4.35%. Between Brent oil at 108 and Japanese insurers stepping back from bonds, the global savings pool is simply too shallow to keep yields down. There isn't a marginal buyer left at these levels. I'm wrong if the Fed's statement explicitly highlights labor market cooling, which would be the only narrative strong enough to make traders ignore the energy pressure.
You missed that exact number by a basis point yesterday and decided the problem was commitment. At this point, you're basically arguing gravity needs one more vote.
Okay, so we've got Tom on tech weakness into Powell, Ray on yield pressure, both of them basically saying the same thing through different instruments. But here's what I notice. AMD's getting hammered harder than Nvidia in the pre-market, down over 4%, and that's the tell. It's not a broad chip rotation, it's margin anxiety. People are worried AMD can't defend its gross margins if this infrastructure build-out actually requires price competition with Nvidia for the bulk orders. So my call is AMD closes above 320 today. That's about $4 below where it was yesterday, which feels like the real equilibrium if Powell doesn't completely panic the room this afternoon. I'm wrong if Nvidia guides down on AI server pricing and drags the whole sector with it.
If AMD manages to hold 320, it tells me the market is betting that AI demand is completely inelastic to the soaring cost of the power running those chips. But with oil at 108, those margins aren't just fighting Nvidia, they're fighting the global energy grid for every single cent of profit.
We'll be back tomorrow to see which part of reality the market ignores next.
Let's see if gravity finally gets that last vote on the yields today. See you all tomorrow.
All right, that's the board for today. Thanks for being with us. You can find the show and all our previous calls at 3clowns.co, and you can reach us rs 3clown spot on every platform. We'll score all three of these tomorrow morning, and honestly, if Ray somehow nails the 435 handle after missing it by a basis point yesterday, I'm just going to assume he has a Bloomberg terminal wired directly into his brain. We'll see you then.